We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
One of the trickier decisions of saving for retirement is determining which accounts to prioritize with your savings. Is it most important to max out a 401k before an IRA? At what point should you use a taxable account? And where does debt come into play? This is one of those truly personal finance moments because everyone has different circumstances. Today, I'm going to simplify the decision-making process by explaining the general order of accounts to use in order to maximize those retirement savings. Now, I find it useful to think of each of these categories as buckets. You save into that bucket until it's full, and then you move on to the next bucket. And the first bucket is investing enough in your company retirement plan to earn a match. I see lots of 401k plans, some good, some bad, but this first bucket is the most important regardless of the quality of your plan because it's hard to find a guaranteed 100% return on your investment. But an employer match does just that. For example, if your employer has a 3% match and you make $100,000 a year, you'll need to contribute at least $3,000 of your own money to your 401k to be entitled to your employer's full matching contribution. So if your employer offers a match on some portion of your 401k contributions, invest at least that much. Otherwise, you're leaving free money on the table. Once you've invested enough in your plan to receive that match, then you can move on to the next bucket. Now, I've been saying 401k, but this applies to any employer-sponsored retirement plan, such as 403bs, 457s, or simple IRAs. If your employer doesn't offer a match, then I'm actually going to encourage you to move on to the next bucket prior to saving in your employer's plan. And that next bucket is investing the maximum allowable amount in a health savings account, or an HSA. An HSA is a special type of account available to people in a high deductible insurance plan that they'll use to pay for medical expenses and other qualifying health-related costs. I often find that people are more familiar with the FSA, or the flexible spending account, but that's different. The HSA, when it's used as a retirement savings vehicle, offers a really unique triple tax advantage that's unmatched by any other type of retirement savings accounts. The first tax advantage is that contributions are 100% tax deductible. The second is that interest and earnings are completely tax deferred. And then the third is that withdrawals used to pay for these qualified medical expenses are completely tax and penalty free. Now, healthcare costs are a big part of retirement spending, so being able to make tax-free withdrawals for those expenses is pretty advantageous, but it gets better. If you keep your receipts, you can withdraw funds from past medical expenses too. For example, let's say you have an HSA that's $1 million at retirement, but that your medical expenses don't require nearly that large of a balance. You can make tax-free and penalty-free withdrawals for medical expenses from your working years. Of course, this requires you hold on to medical receipts, but there are a lot of apps out there for doing just that, and even some HSA providers have that feature built into their platform. I use Lively, for example, and I scan in my bigger medical expenses to my Lively HSA account so that I can make withdrawals in the future if needed. The max an individual with self-coverage can contribute to an HSA in 2021 is $3,600, and for those with family coverage, the limit's $7,200. Now, if this all sounds too good to be true, I'll admit I sort of felt the same way, and usually there's a catch. I suppose the biggest catch is that this strategy, to work well, you're going to need enough cash flow to contribute the maximum allowable amount each year and manage to pay for medical expenses out of pocket. That's what's going to allow you to leave those HSA contributions invested for years to enjoy the unusual tax benefits and the compound growth. Of course, paying for your medical expenses without tapping your HSA maybe would require not just good cash flow, but also having a decent emergency fund to fall back on if you have a really large unexpected medical expense. The other catch, if you want to call it that, is the extra legwork involved in using a high deductible plan rather than the more traditional PPO or a preferred provider organization plan. Because you're basically paying for the full cost of your medical expenses out of pocket until you hit your deductible in these high deductible plans, you also have to pay closer attention to the treatment you receive and what you're billed for. A lot of people prefer the convenience of saying yes to whatever test the doctor wants to run and letting insurance handle the bills. But when you're paying out of pocket, you really have to take ownership of your care and you have to make cost-effective decisions. In return for that extra effort, though, you're getting a really powerful tool for retirement. And even if you end up dipping into your HSA savings to cover some medical bills, you're still going to get that tax break on the contribution, and you'll probably benefit from lower monthly premiums. One last thing before moving on from HSAs, in order to access the HSA, you have to be in a high deductible health plan. And not all employers offer this type of coverage, and it's not always the best choice for everyone. You'll often hear people say that high deductible plans tend to be great for someone that's young, healthy, and doesn't have children, but I think those categorizations exclude way too many people. In reality, it comes down to your expected medical expenses. So if you or your dependents utilize a lot of specialists or require regular hospitalizations, a PPO might be better for you. There are tools that health insurers offer online to come up with an expected medical expense for a given year. So if you go through that process, then here's how I would choose between the high deductible plan and the PPO. Basically, it's you choose the high deductible plan if your expected medical expenses is less than the sum of the savings in your monthly premiums, plus your employer contributions, plus the PPO deductible. Otherwise, you choose the PPO. So that's bucket number 2, the health savings account. Bucket number 3 is investing in a Roth IRA or a deductible traditional IRA. Which account you would choose depends on your income. If you're eligible for a Roth IRA, then this is the next best place to direct your retirement savings. If you can't invest in a Roth account because you make too much income, the next best option is going to be making contributions to a traditional IRA, so long as you're able to deduct those contributions from your income. Both the Roth and the traditional IRAs allow you to grow your money tax-free, but the difference is in the timing of the tax payment. A Roth IRA is funded with after-tax dollars, meaning your contributions don't receive a tax deduction on the way in, but your withdrawals from the Roth IRA are tax-free. A traditional IRA, on the other hand, is funded with pre-tax dollars, meaning you deduct the contribution from your income, and the withdrawals are taxed as ordinary income. If your income is too high to qualify for the Roth IRA or a deductible traditional IRA, you can still contribute to a non-deductible IRA and enjoy some of this tax-deferred growth, but that's actually one of the buckets that comes a little later. The next bucket, though, that we're going to talk about is number 4. It's investing the maximum allowable amount in your company retirement plan. Employer-sponsored retirement plans are usually the cheapest place to access a diversified set of investments for retirement. More and more of these plans also allow you to make contributions to a Roth or a traditional account. The way you choose between the two in this case is if you expect to be in a higher tax bracket during your retirement than the one you're in today, the Roth 401k is going to be the better option. If you expect to be in a lower tax bracket during retirement than you are today, a traditional 401k probably makes more sense. If you aren't comfortable projecting whether your taxes will be higher or lower at retirement, then maybe you consider making contributions to both the traditional and the Roth options in a strategy that's known as tax diversification. Now, I've been saying 401k, but if you work for a nonprofit entity with access to a 403b, this applies to you as well, and you should be aiming to max out that vehicle at this stage too. Same goes for government employees with access to a 457 plan, and smaller employers sometimes provide simple IRAs or a simplified employee pension SEP IRA option, both of which would fall into this retirement savings prioritization category too. Now, if you have a really good plan, then it might make sense to prioritize this bucket before the IRAs I described earlier. And there's 2 things I'll look for in determining if a plan is really good or bad. Emphasis on really good or bad. The first one's going to be low fees. That's a big one. And most plans have a variety of fees. There's the expense ratio of the funds, which is really the most commonly recognized one, I think. But there's also fees that go to the investment advisor, the record keeper, and the third-party administrator of the plan. Now, sometimes they're all wrapped together, but fortunately, fee disclosure is required by law. So when you get your statement, you ought to be able to look at the total cost of being a participant in your plan. And I'd say all-in costs below 0.5% is really good. That's when you know you have a really good plan. Maybe you prioritize this bucket ahead of the Roth IRA or the deductible traditional IRA. On the other hand, if you have all-in costs above 1.5%, that's closer to that really bad category. But sometimes companies with smaller than 50 employees will be in that range. A second thing I'll look at is whether the investment lineup has good offerings or not. And I think it's actually easier to talk about what makes an investment lineup bad than good. For example, a mutual fund lineup that only includes actively managed funds is less than ideal. It's becoming rare for plans to not offer at least a few low-cost, passively managed funds. But if you're in a plan that doesn't, that's definitely a minus in my book. And just to make sure everyone's on the same page here, traditional active management uses security selection and market timing in an attempt to beat a benchmark such as the S&P 500 or MSCI EAFE or the Barclays Aggregate Bond Index. While active management can sound appealing, who doesn't want to beat a benchmark? The failure of active management is very well documented. However, there's something that I think makes a lineup even worse than when it has all active management, and that's when there's a plan that mostly offers annuities. And you tend to see this more in the 403B space, particularly plans that serve teachers. These annuities, they tend to be more expensive than mutual funds with similar exposures, and they have far less flexibility when you change employers or you go to withdraw your money in retirement. Just to reiterate one final time, if you have a really good plan, you might consider prioritizing this bucket over one of the prior buckets. If you have a really bad plan, though, this is still going to be a good place to maximize because there's still that tax-deferred growth. There still can be an income deduction, so you don't want to skip over this bucket entirely. On to the next bucket, investing in a traditional non-deductible IRA. Contributions to a non-deductible traditional IRA don't receive a tax break, and the contributions, when you're withdrawing them, they come out tax-free, but the interest and earnings are taxed as ordinary income during your retirement. But you do enjoy the benefit of tax-deferred compound growth, so still a really good account. For some investors, they'll use this account in a strategy known as a backdoor Roth contribution, where you contribute to a traditional non-deductible IRA and then convert the balance to a Roth IRA at a later date. And this can be particularly useful if you expect to be in a higher tax bracket in retirement. When you convert an IRA to a Roth IRA, you have to pay ordinary income taxes on any of the appreciation and earned income experienced in those IRA accounts, not just the one you're converting, but all of your IRA accounts. And so that does mean that the Roth conversion process requires a little bit of analysis on the tax cost, your life expectancy, and the desired beneficiary of the assets. There are lots of nuances with this strategy, so I'll be sure to link to an article on the topic in the show notes. But in my opinion, the tax benefits of the Roth conversion are often best suited to retired investors who are under the age of 72 because they aren't taking those required minimum distributions yet, and they have little to no ordinary income. Now, if you're working and you have existing IRAs with considerable appreciation, this strategy is often not worth it. And finally, bucket number 6, our last bucket. If you've reached this point, you're doing a great job saving for retirement. The key with investing in a taxable account is going to be the tax efficiency of your investments, and assuming that you're utilizing some of the tax advantage retirement accounts that I've already spoken about, there's also probably going to be some opportunities to benefit from asset location strategies. And I also want to thank everyone who's left a review. I've enjoyed reading every one of them, but writing a review also helps more people find the show, so thank you for taking the time to do that. If you're looking for show notes or resources mentioned during the episode, visit thelongterminvestor.com, where you can also submit questions to be answered in an upcoming mailbag episode. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.